Victoria's land tax changes are hitting SMSF property investors harder than ever. In this video, we explain how the latest threshold reductions and rate increases affect your super fund and how to protect your retirement wealth. Let's dive in.
So a lot of us dream about using a self-managed super fund to invest in property, right? Building up that nest egg for retirement. But here's the thing. If you're a trustee with property in Victoria, there's a silent cost that could be seriously eating away at your returns. Today, we're going to pull back the curtain on the Victorian land tax and some major changes you absolutely need to know about.
So let me ask you this. Are you unknowingly losing a chunk of your retirement savings? I mean, you've worked incredibly hard to build that up, but a hidden tax could be silently draining it year after year. Let's find out if this is happening to you, and more importantly, what on earth you can do about it.
You know, using an SMSF to buy property has become this classic move for building wealth for retirement. And you can see why. It offers a level of control and some potential tax advantages that are pretty hard to beat.
Ever wished you had more say over where your super goes? Well, that's exactly what an SMSF is all about. You're in the driver's seat. You get to call the shots. You decide exactly where your money is invested, and that's why so many people are drawn to them to buy property directly.
And when I say popular, I mean really popular. Just look at this. A whopping 15% of all SMSF assets in Australia are parked in real estate. It makes sense, right? You've got the potential for capital growth, that's steady rental income, but there's a catch. And it's a big one if you're investing in Victoria.
And that catch is the Victorian land tax. People call it a silent wealth eroder for a very good reason. It can slowly and steadily just eat away at your investment returns if you're not ready for it.
So how does this thing actually work? Well, think of the tax-free threshold as like a hurdle. Once the combined land value of all your Victorian properties in your SMSF jumps over that hurdle, you start paying tax. And this is really important. We're talking about the land value. Forget the house on top for a second. It's all about the dirt underneath. And this is where it really starts to hurt your returns. See, it's not a tax on each property by itself. No, it's on the total combined value of all the land your SMSF owns in the whole state. It's also progressive, which is just a fancy way of saying the more land you own, the higher the tax rate you pay. And here's the real kicker. You can't just pass this cost on to your residential tenants. It comes straight out of your retirement fund. Ouch.
And you know what? This isn't some rare mistake. It's super common. As this property expert points out, people get laser focused on the purchase price, the rental income, and they completely forget to factor in this tax. And then bam, they're absolutely shocked when that first bill arrives in the mail.
But here's the thing. Even if you knew all about this tax, the rules of the game have just been flipped on their head. There's been a recent and frankly, a massive shift that has huge implications for every single SMSF property investor in Victoria.
Yep, starting in 2024, the whole Victorian land tax system has been overhauled. And this isn't just a little tweak here and there. It's a major change that is going to pull thousands of properties that were previously exempt right into the tax net for the very first time. And this is the change I'm talking about. Look at this. The tax-free threshold, that hurdle we talked about, it's plummeted from $300,000 all the way down to just $50,000. That is huge. This means that now, even a single, pretty modest investment property in an SMSF is very likely going to get a land tax bill.
So what does this look like in real numbers? Well, this table lays out the new brackets. You can see there's a whole new tax rate for properties with a land value between 50 grand and 300 grand. And just like before, as your portfolio's value climbs into those higher brackets, the percentage you pay in tax just keeps going up.
All right, so that's the challenge, and it's a big one. But, and this is a big but, you are not powerless here. There are absolutely ways to manage this. So let's dive into some key strategies you can use to minimize the hit this tax takes on your retirement fund. Here are 5 key moves for your toolkit. First up, review your ownership structures. Since the tax is based on the total value in one name, holding properties in different structures, where it's legal, of course, might help. Second, think about diversifying geographically. Land tax is a state thing, so an investment property outside Victoria won't get added to your Victorian total. Third, be smart about the types of property you select. Commercial properties, for instance, can have different tax rules. Fourth, be strategic about when you buy and sell to manage that total land value. And finally, make sure you are maximizing every single deduction you're entitled to. And that first point about structuring, it's a big one. As this tax specialist notes, it is one of the most powerful tools you have. But, and I can't stress this enough,
This stuff is complex. It is absolutely crucial to get expert advice to make sure you're doing it correctly and, well, legally.
Okay, so we've talked strategy, but you also got to handle the day-to-day stuff. You need to stay on top of all your compliance obligations and know exactly when it's time to call in the professionals. So, as the person in charge of your SMSF, you've got some key responsibilities. You'll get an annual assessment notice from the State Revenue Office, so make sure your property records are spotless and you tell them about any changes. And here's a hot tip. If you look at your assessment and think, hang on, that's not right, you have a 60-day window to object. Don't miss it.
Look, let's be real. This stuff is complicated. You're dealing with superannuation law, state tax rules. It's a maze. Getting advice from a qualified financial advisor or a tax pro who actually specializes in SMSFs isn't just an expense, it's an investment that could honestly save you a fortune in the long run.
So that brings us to the big question for you. Is your SMSF property strategy ready for this new reality? Seriously, take some time to look over your portfolio. With these changes in mind, have a chat with your advisor. It's time to make sure your retirement plan is built for the rules of today, not the rules of yesterday.